In this episode, we're talking about mortgage rates and what to do about them.
Well, Grant, we've been fielding many questions around interest rates, mortgages. I think the concern is that people believe rates are rising, and we're already seeing rates rise, higher hurdle rates for qualifying for mortgages, everything like that. So why don't we go into a little bit, start with fixed and variable rate mortgages. How are those rates determined?
That's a really good question, because a lot of people think that they're both determined in the same way, and they're really not. Variable rates, for one, are a little bit simpler because it's simply tied to the Bank of Canada rate. So the Bank of Canada rate is directly related to the bank's prime rate. So when you look at any of the major banks, they have a prime rate, or any major lender has a prime rate of lending. And that's directly tied to the Bank of Canada rate that you'll hear about on the news when the government is raising interest rates. That's the Bank of Canada rate. Now, variable rates are typically determined by a prime rate minus a certain percentage, prime minus 0.75, prime minus 0.5, whatever it happens to be depending on the lender. But that's how a variable rate mortgage rate is determined. They can go up and down, hence the variable part. So as the Bank of Canada raises or lowers rates, that will raise or lower your mortgage rate. And it happens on a monthly basis, or could happen on a monthly basis, I should say. So that's variable. Fixed rates, quite a bit different, not directly tied to the Bank of Canada rates. Although, interest rates are all somewhat interconnected, but they're not directly tied to Bank of Canada rates. They're directly related to government bond rates, which move differently and separately from the Bank of Canada rates. So when you hear about the Government of Canada raising rates or lowering rates, it may not necessarily mean that the bond rates are raising or lowering. They are independent of each other. And so we get into a situation actually kind of like what we're in now, where fixed rates have climbed up, variable rates have remained similar to where they were, but the fixed rates have come up simply because the bond interest rates have gone higher. And if you look at your new posted rates now, as of May 2018, you'll see that they're a little bit higher than they were even just a couple of months ago. So,
Coming back to variable versus fixed rates, why is it important that we have this conversation and that people understand what each of these rates are, what they mean, how they work?
It's really important right now. The fact of the matter is interest rates are rising. Bond rates, we've seen that in the fixed rates, as I mentioned. The bond rates have risen, and therefore new fixed rates, if people are coming off a fixed term and they're looking to renew, you're paying a higher interest than you did a few years ago. And that's just the facts of life right now. Variable rates have come up as well as the Bank of Canada has increased rates, but it's really important to know what you're watching out there, because a lot of people I talk to, their mortgages are coming up for renewal in the next year or two. You want to know what you're looking at, and you want to be careful around this, because if you've overextended yourself with your debts, the new rate that you're going to be getting higher than the last one could be very important to your cash flow going forward. So you want to be really careful right now, and you want to make sure you're in the know, because you might make some decisions today that will affect you 2 years from now. Certainly the lower your debt is 2 years from now when you're renewing, the better you'll be if the interest rates are that much higher, right? So the fact is, rates are probably going to go higher still. We're still at somewhat lower rates historically, and they can go higher, and they probably will. So be very conscious of your debt at this point in time, and it's worthwhile looking at a strategy to pay down that debt. Working in line with your investment strategy, but it is certainly worthwhile looking at a debt repayment strategy at this point in time, and as soon as possible.
Absolutely. What are we recommending to clients, Grant?
Yeah, well, I'd go back to having the plan and having a debt repayment strategy. That's first and foremost. As it relates to variable versus fixed, just like investing, there's a comfort level that comes along with it. So there's a comfort level one from your own psyche and your personality, but there's also a comfort level with your cash flows. And if your cash flow is tight and you can afford the fixed rate, but you're not sure about where the variable rates are going to be, then you might want the certainty of a fixed rate and locking that in for a period of time, like say 5 years or 3 years. But likewise, if you're a little bit more comfortable, your cash flow is a little bit flexible. Historically, variable rates have saved people a lot of money on interest, and we are at a time where variable rates can be quite a bit lower than what the fixed rates are. So it's worthwhile exploring it for sure, but just be very conscious around what's important to you, what your plans are. And what we're recommending is based on your plan and your comfort level. That'll actually help us determine exactly what style of mortgage you should go with.
Recommendation is make sure you have a plan and you've sat down and you've looked at these things so that you can weigh the options.
So many times the recommendation is to have a plan because you can't make an educated decision without having a plan. If you don't have a plan, you cannot make the right decision and know confidently that you've made the right decision.
Well, with that, any questions, you can get to us at whitehoustonwealth@mbc.ca.
Right.
Check us out on our website, www.whitehoustonwealth.com.
Yeah, reach out to us. Send us questions. We love to hear them. So, send them away.
Perfect. Well, with that, we'll sign off.
Ready,
aim,
fire.